Investors, welcome to the High Class Dividend channel. In this video, I want to explain to you how we can protect our income growth every year by working on our portfolio composition and position sizing. Our methodology comes with a bonus. We reach higher dividend growth rates and higher potential for price appreciation. But first, the disclaimer. This content is for educational and entertainment purposes only. I am not a financial advisor. Nothing in this video is finance, legal, or tax advice. Okay, I want to explain to you the advantages of sizing correctly our portfolio positions. We can increase the protection of our income, guarantee income growth for the next year, remove emotions from our decisional process, we'll have a higher dividend growth rate, and finally, higher price appreciation potential. And here's what we do differently. Regular investors will build a portfolio where their positions tend to have the same weight in terms of total money invested. Their reasoning is to risk equal amounts of money in each bet. My problem with this is, if one of the positions represents too much of my total portfolio income, I may be betting the same amount of money, but I'm betting too much of my income. What we'll do is, we'll size our portfolio based on how much they weight on our total income, and the big advantage here is to be able to afford companies cutting or eliminating dividends and still perceive income growth next year. We need to check one fake example to make things clear. This is a random portfolio I built composed by 10 positions. Regular investors will spread their money equally through all positions. What we'll do instead is to put more weight on the companies with lower dividend yields and less weight on companies with higher dividend yields. Here's how the income distribution would look like. My problem with the distribution on the left is that if UPS decides to slash dividends, almost 1/4 of my total income would be cancelled. With our approach, each company bankruptcy or dividend cut hurts our income much less. Let me show you how. This new column here shows how much our income would be reduced if a company in its line decides to halt its dividends payments. How is it possible then that 10% of my income is gone, but we see income decreases that are much less impactful? Let's suppose Badge Meters eliminates its dividends. We would face a 10% income reduction right away. But the dividend growth rate of all the other positions compensate, cushioning the total decrease. Now, this was a portfolio of only 10 positions, therefore each one would mean too much of our total income. Imagine, for example, a portfolio of 50 companies. Each one would represent only 2% of our total income. If one decides to cancel dividends, we would lose only 2% of our income, while all the other 49 positions would increase their dividends, granting us a final balance that is positive. Our portfolio would have increased its income payments even though one company had eliminated its dividends. Such a large portfolio could even afford having some companies slashing dividends. So, if we put together all layers of protection we added to our portfolio, firstly, we focused on companies that present high dividend safety index. If you watched my previous video, you have an idea on how we calculated this one. Then we focus on companies with high dividend growth rates to compensate for possible dividend cutters. Again, in my last video I showed you the concept of dividend potential. Those two together basically mean we are driving our attention to only high quality companies. And then we still have a third layer of protection, which is the number of holdings in our portfolio, which impacts in a not so meaningful income weight for each company. Dividend cuts don't feel that bad. In my opinion, with all those three layers put in place, it is possible to secure income growth for our portfolio every single year and without the addition of new capital. Now, what else do we gain from our portfolio composition process? Well, if I have to put more weight in companies with lower dividend yields, then those are the companies that usually have high dividend growth and high potential for price appreciation. We are also putting less money on companies with high dividend yields and therefore lower growth. unintentionally we build a portfolio with much higher price appreciation potential. To end, I want to be transparent and list the disadvantages of this process. 1. Risk of putting too much money in one single position. People looking at this portfolio composition would find it hard to believe 25% of our money lies in one single position. To me, risk is losing income. Yet, if I'd have a portfolio with many more positions, my money would be spread so much more, limiting the amount I would put in my biggest position. And let's not forget our due diligence process for choosing only high quality companies. So, my answer to this disadvantage is yes, I recognize it, but I think it's a low risk. 2. At start, all positions are equally distributed in terms of income weight, but with time, this gets unbalanced. True, this happens, and that's why we have a rebalancing process for our portfolio. Or I could simply add new money in low weight positions, reaching a natural rebalance. If you want me to make a video about rebalancing, let me know in the comments. The third and last disadvantage is that by having too many holdings, we are decreasing our chances of outperforming the market. I don't think we need 50 positions to leverage on the advantages we mentioned in this video, but still, I don't expect to beat the market, so I accept this risk. Okay, this is just a slide to show you a portion of my favorite books when it comes to dividend growth companies. Most of my ideas come from them. If you love books like I do, I think those are great. I'm leaving their Amazon link on the description of this video. And that's it. Don't forget you can check my portfolio on eToro. It's public, link is in the description. You can even copy it automatically. All operations I do, new buys, new sellings, rebalancing, everything I do. I have just started building it. I have only 2 positions, so it's a great moment to start a copy. I hope you guys have liked this one. Please leave a comment with some feedback or requests for future content. If you can, leave a like and subscribe to the channel. It helps a lot, and I'll see you in the next one.